Good morning, everybody. Happy Monday. I hope everyone is doing well. We are unfortunately encountering some video issues, right? But other than that, everything's okay. So other than not being able to see me, we're good, which is not really a problem. So let me just quickly make sure that the audio is working, though. If you guys can just quickly let me know. If the audio is working, then that would be great. If you guys can hear me, just give us a quick yes. Perfect. Okay, very good. Very good. All right. Let's see here. Very good. Yeah, again, like I just said, unfortunately, the video's not working this morning. That's typical. The fun of YouTube is always some issue. But anyway, we're here. So thanks for being here. I'm sure we'll get the video worked out again tomorrow. We do have a busy week this week, and the busy week actually starts with lots of corporate earnings. So I do want to talk about that. We've got some news this morning, or actually yesterday, on that essentially, if you will, lawsuit against the Fed and stuff like that. So we'll see if it matters. It does matter for gold and silver. But other than that, the equity market, is about earnings, so that's a bit of a different story. But I wanted to start off this morning by going through what really is our sort of theme for the year. We have a special set the market, a special state of the market coming up. I think it's the week after next, where we're going to address this very specifically. But we call this the year of the Great Rotation. And to give you a bit of an idea, this here is the month to date, so basically the year to date performance of sectors of the S&P 500. Now, if you look at the upper right-hand corner, you'll notice that the XLB ETF, which represents the materials sector of the S&P 500, is up about 6.5% on the year. You will notice that industrials and energy stocks are pretty close second, up about 4.5%, 4.4% each. And then you can kind of see the trailing ones down there. So when we talk about the Great Rotation, we think this is very emblematic of what's going on. And I should also maybe at this point go right back to the chart that we talked about most of last year, which is the relative outperformance already of stuff versus the mega cap tech space. So this is the 1 year look back now at the performance. You can see silver is up there, gold is up there, gold miners, platinum, copper, palladium. All the German stocks are up 38% over 12 months. You know what's not up 38% in 12 months? How about your Mag 7, right? So the rotation is happening. It's just, it's such a big beast that when it happens, it typically takes a bit to get going, and then ultimately everyone's on the wrong side of the coin. And this is also really why we think a lot of people are going to have flat returns in their portfolios for the next 5 to 10 years. So when we look at this rotation, we can also look at it in another way. And I would like to show you a little bit what that looks like. This is something that's been, it's just essentially, looking at it in a different way, but telling us the same stories. Or here, what you have is emerging market stocks, right? So emerging markets, which of course everyone always writes off as being dead, is basically now testing, a major potential breakout. Now, this is a long-term chart. This is not a chart that is going to break out here tomorrow, but it's, I think, an important one. What I want to show you, which is, I think, much more important, is emerging markets. If you divide emerging markets by, let's say, the NASDAQ 100, okay, so EEM, which is an ETF that represents emerging markets, divided by the NASDAQ 100, you get this chart, okay? And I'm going to show you the inverse of that as well for those of you guys that like to look at this a little bit more sort of through the lens of a bearish thing. But here is the chart of emerging markets versus the NASDAQ 100. So basically emerging markets versus Mag 7 stocks, right? And there's a pretty meaningful bottoming phase. It doesn't become as apparent unless we flip it upside down. So if you look at the QQQ and we divide that by EEM, so this is now the inverse of that, this is what the chart looks like, okay? So sometimes this is a bit more telling to people when they see the bearish version of it. Now, this is not the end of the world yet, not even close, but we are seeing what some might refer to as some sort of a head and shoulders pattern kind of thing. What I will tell you, and I made a video about this last week, is we actually, I think, have a 3 drives to a top pattern. You guys can go back on the YouTube channel here and see my video on 3 drives to a top. I think we did it on the stock called STX, which is a chart chaser name. Let me see. Yeah, Seagate Technology. There you go. This is the same pattern we're now seeing in that ratio of the S&P 500 versus, of what was it? The NASDAQ 100 versus EEM. We'll go back to it in a minute. But the 3 drives to a top pattern, or in this case, it's a 4 drives to a top. It's the same thing. You see, we're already going vertical, right? So then we have 1 drive, 2 drives, 3 drives, and a 4th one, which now looks to be failing. This is just a single name stock. Is one of the favorite chart chasers names. If you look at the chart that I just showed you, which is, again, QQQ divided by EEM, yeah, I think this is it. Again, we have to look at this through a longer term lens. So this is like the weekly chart, right? So these are weekly bars. So this is a long-term chart. But again, we have a similar pattern. We have that 3 drives to a top. So this is not to say that the NASDAQ 100 is going to fall apart tomorrow. This is a multi-quarter view. But again, you can see that 3 drives to a top. 1, 2, 3. Sometimes you get a 4th, but 3 will typically do, right? And it happens after a very, very long run. So I just wanted to show you that. So this is basically the same thing that I mentioned before, but it's now happening here in relative terms. So the rotation we're seeing from basically Max 7 bubble stocks from an allocation perspective, right? They're not bubble stocks in terms of they make a lot of money. But from an allocation perspective, everyone's dramatically overweight 7 stocks, and thus basically the S&P 500. This is probably one of the best asymmetrical setups I've ever seen in my life. I think the rotation that we're going to see from the Max 7 kind of centric portfolios into many other things, specifically a few things that we'll reveal in our state of the market in, I think, at some point next week, is really what we think is the opportunity. Now, you can also look at this and look at this through the lens of, for example, news that we had last night, which was basically the Fed getting, once again, kind of be jeopardized in its own independence. That's how the market takes it. We're not doing politics here, so please don't take this as a political statement. Zero politics. All we care about is the markets. But if you look at gold and silver now, I'm going to quickly show you this. So this is the price of gold. I'm going to give you the daily chart. You can see gold this morning is up 2%. You know what's not up 2%? How about your favorite Max 7 stocks, right? How about the price of silver? This morning, I think, is up like 6% or something like that. Yeah, almost 6%, right? So these things are going higher because of the monetary debasement that we keep talking about, right? So that's a bit of an idea on the great rotation, a bit of an idea of, again, the year-to-date performance. We already talked about the year-to-date performance, right? Let me quickly go back to that so you can see that. If you give me just 1 second here. Sectors. Yeah, we talked about the year-to-date performance, right? So that's, yeah, here, month-to-date or year-to-date. It's the same thing in January. Again, you can see where the money is rotating, right? So that's clearly a continuation of what already happened last year. Max 7 stocks did okay last year. That's not the issue. The problem is they dramatically underperformed, and that's usually a precursor for absolute underperformance and basically a flat S&P 500 for maybe 5 to 10 years. At least that's our case, our base case right now. The other thing I want to point out is, there's always, in January and February, as I said last week, there's always a lot of potential tape bombs. So if you look at something like Capital One Financial, ticker symbol COF, which I'm sure everyone's bullish on, the stock was down about 2.5% on Friday. The problem is that this morning it's down about 10, right? on the back of that news out of the administration that they're going to start capping credit card fees at I think 12%. So this stock this morning at its lows was down around $220. So these are some of the opportunities that we're going to start looking at. I can't tell you right now whether this is a buy or a sell, but this is the kind of opportunities and erratic behavior that we tend to see in markets in January, February, which is why I continue to reiterate that I think January, February are very difficult and potentially dangerous months to be too cute, right? To just act as if everything is normal. January, February is not normal. It's typically a great time to reposition portfolios and make sort of multi-quarter views. If one does trades, they typically have to be a bit shorter in duration. You know, if one's typical swing trade is an idea of 2 weeks, maybe in January it's closer to a few days to a week or so, just because January and February and even March, unfortunately, can be very, very choppy. Okay, so that's what's going on. We have JP Morgan earnings I think tomorrow, actually, my alma mater. So we're going to watch that very closely. And John is asking, is it rotation out of Mag 7 or new money going into sectors other than Mag 7? It is definitely a rotation at the margin coming out of Mag 7. It's a rebalancing of portfolios, John. The S&P 500 is essentially almost 50% is tech stocks. While 7 stocks don't make up 50% of the S&P, the correlation metric, the machines act that's why you can see something like I'll show you this, right? So NVIDIA, for example, hasn't really done much for a while. In fact, I know this is not something people like to hear, but NVIDIA is at the same levels today as it was in July, more or less, right? It's not something you hear on your favorite TV station about, but this is the reality. Now, typically, when you have a market this concentrated, it's largely about machines and correlation. And so that's why you can see a stock like NVIDIA essentially drag down the entire tech sector, not because it's the only game in town, but it's because the machines and everything else look at it as the one tell to kind of drag everything up or down. So that's kind of the reason for that. So again, I apologize for our video issues this morning, and I say video, it's largely the video of me. I'm sure most of you will be able to be just fine without having to look at me, but we will hopefully be back with the video tomorrow. It's sometimes these technical gremlins on YouTube are just what they are. So we'll leave it at this. This is our morning call here for Monday. It's still Monday. It's Monday, January the 12th. Again, thank you all for being here. Please make sure you subscribe to the channel. That allows us to be able to continue to do this show. And also, of course, you get updated in real time when we go live. If you can give us a thumbs up like on all the videos, including this one, that would be awesome. And we look forward to seeing you guys back here tomorrow morning. If you are a Trade Ops member, of course, we'll see you in the members' rooms here later on this morning. Thanks for being here. Again, good luck this week. It's going to be a busy one, as you probably already noticed with the news flow. Stay safe out there and stay patient. Thanks so much, and we'll see you tomorrow.